Well, hello, everyone, and thanks for joining. My name is Grayson Geiler with SES Services. We do weekly market updates, so we pick a topic in the financial media and discuss it with a little more detail. So this week, we'd like to go through the risk-off mode that Wall Street has put itself in. A very rough week last week after inflation numbers came in really hot, hotter than expectations, still over 8%. And now a lot of market pundits are taking risk off the table. So that's what we're going to go through today. So a month ago, I shared a similar chart. This is the yield curve, the spread between the 10-year interest rate on the treasuries and the 2-year interest rate on the treasuries. So you see when we get below that red line, we have an inverted yield curve, meaning short-term interest rates on the 2-year are higher than long-term interest rates on the 10-year. So when you rewind and check out, this was what lots of people have heard that Paul Volcker in the early 80s launched short-term interest rates, and we had a drastically inverted yield curve. You see the 2-year back here was more than 2% higher than the 10-year. Of course, that initiated the recession in the early 80s. And as you can see from the chart, an inverted yield curve has predicted the past 7 recessions. Well, here we are today with the 2-year interest rate higher than the 10-year interest rate. And because of inflation numbers last week, a lot of people think the Federal Reserve is not only going to raise interest rates this week, 75 basis points, but the probability is going higher that it may be a full 1% rate increase. So when you have inflation running and people think the Federal Reserve is going to have to raise rates a lot, and then we go into risk-off mode. So some of the riskier assets that are damaged by higher interest rates, people are pulling money off the table. So that's what we saw last week. The S&P 500 gave up a little more than 3% in 1 week, with obviously a pretty bad week. And going forward, we'll see this is where the rubber meets the road with the Federal Reserve is going to have their announcement later in the week. Now, one of the things I'd like to discuss today is just a very simple to take a look at raising interest rates as a strategy to rein in inflation. And a lot of times when we watch the financial media right now, it seems like a one-to-one obvious situation. Hey, inflation's still running high, so the Federal Reserve needs to raise interest rates more. Strangely, it's not that simple. So when you take a look at how low interest rates were, Japan's a great example. For decades, interest rates were so low, even negative, and that didn't spur the inflation. We never got to a point where there was inflation to raise rates into. Low interest rates actually, on the supply side of things, encouraged investment in production. So the supply side of things brought inflation down. Now, that's kind of the opposite of how the Federal Reserve, or at least the financial media, talks about the Federal Reserve situation now. They talk about lower interest rates spurs inflation up, higher interest rates pushes inflation down. Well, that may be true on the demand side of the curve, but on the supply side of the curve, that's obviously false. One of the things we need to understand now is that the Federal Reserve is going to get to a point, if they keep raising interest rates, and especially as quickly as they are raising interest rates, they're going to discourage investment in new production. Whoever is doing the producing and needs to borrow money to get production facilities going, obviously higher interest rates is a detriment to that, is discouraging them on that front. And when we have world leaders seemingly set on creating an energy crisis, maybe this higher interest rate, and as aggressively as we're taking interest rates higher, it can actually make the situation worse. Now, I hope the Federal Reserve, if that is what's going on, the Federal Reserve can realize some of this and try to pull the reins in a little bit, but we'll see. Because I mean, when we looked at Federal Express came out today, and Federal Express is a good economic indicator because that represents goods flowing around the economy. People are shipping things to each other through FedEx, and FedEx came out with some really bad, or came in with guidance that was really bad last week. So much so, I think FedEx was down more than 20% at one point in the trading day last week. So really not a good indicator for the strength of the economy going forward. And hey, are we in a situation now where raising interest rates is just going to squash demand and supply? So a recession is the only way out of this inflation. We'll see how things go. Sooner or later, the Federal Reserve is going to have to rein in the speed with which they're raising interest rates, because some of these things take some time to actually filter through the economy. So they may be initiating a little more than they anticipate to with so much higher interest rates, and I certainly wouldn't want to see panic on the other side. So risk off. That's kind of the mantra out there right now. We don't do a lot of trying to time markets, but again, just like I said last week before the sell-off, I said, look, if that was a great spot to lighten up in a portfolio, if you felt like you have too much risk on. If market fluctuations are keeping you up at night, you need to peel some risk off your portfolio. After a big down week like this, generally historically there has been some bounces, so people don't have to panic and sell red. But again, the Fed's coming out this week, and if they do raise more than the 75 basis points, not really sure how the market's going to react. So if you need to tighten things up a little bit, hope you found this informative. If we can help, just reach out to us. Here's our phone number. We've got to contact us at sesweb.net. Please hit the like button below. You can forward this on to friends and family if you enjoyed it, and we hope to see you next time.